Hey there everyone, it's Joe from Ainsley's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainsleyBullion.com.au. Today's topic is US tech stocks plunge upon Q3 earnings release. Now that's posted on the Ainsley website. I'll put a link below for you to follow along. And of course, we have Chris Tipper here to break down the morning's news. And joining Chris today is the author of said news and regular Ainsley team member, Branko. So, Branko and Chris, over to you.
Thanks, Joe. We are right in the middle of the US earnings season, with reporting of Q3 results coming in every night our time at the moment. Although many of the results across a range of industries have been outperforming expectations, technology stocks seem to have been the first sector to feel the full impact of inflation and the central bank policies to fight it, hitting their top and bottom line profits. Today, Branko joins us after having a closer look at the big names suffering the significant pullbacks to help guide us through what all of this means for specific companies, but also for markets more generally. So welcome back, Branko.
Thanks for having me back on. Love to be here.
So I know you've sort of dug into these big names that were taking some hits. So can you maybe give us a little bit of an overview of some of the names, who they were, and maybe some of the main causes for those lower earnings for those tech companies?
Yep. So just a brief kind of overview. This morning we had Facebook come in. Their earnings per share came in at well below its projected amount, which was 49% less than this time last year. And the other name is Microsoft yesterday, which they came in very low as well, and similar to Alphabet, which is Google. Alphabet came in at 27% less profit than this time last year. And the main reasons...
That hit all of their share prices quite suddenly, didn't it?
Yeah. So I think for Google, it was 7% decrease. For Microsoft, it was 6% in one day. And then Facebook was, 6% as well. So quite significant moves. And I think the main catalysts were these macroeconomic factors we've been talking about for a while here at Insights. So for Facebook specifically, it was foreign exchange. Zuckerberg came out and said that if the exchange rate was the same as this time last year, it would have had a 7% difference in revenue. So the revenue would have been 7% higher if the exchange was stable. And then Microsoft also came out and said that the energy crisis has hit them quite significantly, and they've had to pay an extra $800 million in energy costs thanks to the energy crisis.
So there's some big I suppose, wild cards that were thrown at them. And potentially that's going to impact a lot of other industries as well, you would imagine, as they flow through, because surely other industries will be impacted by the energy crisis and energy prices into the future. But what industries might perform better than expected, do you think? Because they might be less impacted by some of those factors that impacted those tech companies specifically.
Yeah. So I do think taking the polar opposite of what Microsoft is going through, like agile energy companies, like a lot of companies in the US involved in liquefied natural gas that are able to transport their energy to Europe, can take advantage of kind of the crisis there in a way, and they can see higher revenue. We've seen companies like Boeing come in at a much higher free cash flow because they're able to kind of dynamically change their prices to adapt for inflation. So I think we're going to see a lot of these companies that are hedged in terms of energy and they're a lot more agile in their price movement perform quite well.
Okay. So you've given us some there that, particularly in that energy space, that can take advantage of that. But surely none of this is new. Like, we've been talking about these things for a while now.
Yeah.
These reporting seasons come about every quarter. So, we haven't really, a lot has happened in the last quarter, but it's not completely different from where we were a quarter ago. So the projections that people are making, they're quite off, right? Really, when you think about it, we've got expectations not really matching at all, particularly with those tech companies you highlighted, what happens. So why do you think they're so far off? How do they get that so wrong?
Yeah, so I find this quite interesting that all these analysts and all their projections have been wildly off. So I didn't run through it before, Facebook earnings per share came in at 1.64, was projected to be 1.89, right? Microsoft as well came in a lot. Their revenue came in a lot lower than expected. So it's quite a common theme. And I think that it is very interesting to kind of observe this on a broader level as well, where we see the share market try to consistently break away and decouple from the Fed's rate rises. And we're kind of seeing that on this micro level with the analysts trying to consistently decouple these companies from like the broader economic sentiment. Like even with this rampant inflation and the energy crisis, among other factors, it affects their profits, and the analysts are trying to like not consider that as much, similar to how the stock market is trying to be overly bullish.
So do you think, because I've been having this conversation quite a bit at the moment around this idea of fighting the Fed, right? And it's like everyone knows that. It's the base rule that you have, don't fight the Fed. We know what the Fed is doing. We know what they're attempting to do, but it's like everyone thinks they're different. So that's probably what you're kind of saying here, I think, that every company thinks, oh yeah, that's, you don't fight the Fed, this is going to impact everyone else, but we're special. We're different to this for some reason. So when you have that happening with everyone thinking they're different, that's kind of the problem. Is that how you see it?
Yeah, I think that's a great way to view this, is that everyone's trying to fight the Fed because they think they're special. But in reality, these things are finally coming home to roost now, and we're seeing the true impacts of inflation and the energy crisis and the raging US dollar, which is really negatively impacting all these businesses. To give an example of that more specifically, it would be like Facebook, right? So if they have to pay their marketing and advertising in US dollars, and a smaller share of their revenue is based in the US because they're obviously a global company, then a decreased Australian dollar revenue coming in, it would cost more for them to pay for that US dollar advertising. So, we're kind of...
They would be reluctant, I imagine, in that scenario to raise prices for Australian customers, for example. So if you're advertising on Facebook and your costs are whatever they are in Australian dollars, they can't just raise that because the Aussie dollar's fallen. Like that would take a long time, I imagine, to filter through.
Yeah, and it's certain companies as well are particularly, it's like a Facebook, are particularly can be typically difficult with this. So I think we're finally seeing these economic factors coming home to roost, and as much as people might want to try and fight the Fed, at the end of the day, almost everyone's going to face these consequences from these rate rises.
So we might start getting some more consistently aligned predictions from these analysts as they see more of it happen. But for now, they're being probably overly optimistic, which is something we talked about yesterday when Josh was on, risk relation to the budget as well. You've got a lot of optimistic expectations built in there, but they may not have really factored in the reality of what we're facing at the moment and what we're going to face ahead. So with all that in mind, what was your sort of expectation? We've got Amazon and Apple, two of the big two of the top fangs, really heavily weighted in the indices. They're reporting tonight. What do you sort of see likely? Is that going to be more of the same, and will the market react? Because so far the market's actually been quite strong.
Yeah, I'm very interested to see how it's going to play down if the market has priced this in. I think that Amazon is probably going to have much better earnings than Apple, just because I think the way their business is run, it's probably a lot less impacted by these kind of economic factors. I do think that after Facebook's results last night, we might have already had some damage that's been done. So I think the damage is going to be a lot less because you've had more companies that have showed these negative earnings, so it's a bit more priced in.
Right. So you get a big leader like Facebook and or Meta, as with all of the stuff that they're incorporating, allow people to price in, okay, we expect lower results from the Amazons and Apples that report later. That makes sense. So I'm just going to change angle slightly. We've had a question coming from Stuart, who's a customer down in Melbourne. Yesterday when we were talking, and actually for a while now, when we've been talking about the inflation rate, and we're talking about inflation expecting to continue to go up or stay strong for a while, he's asking for a little bit more detail around if we'll see a sharp rise in the gold price, or if we expect that to remain stable, and some sort of timing on that. So for how long do we expect that to stay stable for, or to rise for? Do you have any sort of thoughts around that?
Yeah, the angle I would take with this and kind of my thought is, people are very fearful at the moment, and when people are fearful, they just want to hold cash. So a lot of people probably aren't being the most rational, and they're just having all their spare funds and capital into cash and not putting it in gold. So I think over time, we will see people start to wise up as inflation kind of eats away at their gains, and they'll move into gold. But for now, there is a bit of a lag, and given the fear, they're just holding it in cash and hasn't really been put into gold at the moment.
Sure. And Josh talked about that a little bit yesterday as well, where he was sort of giving this idea around liquidity, that gold is very liquid and that's its biggest benefit. So during this initial period of the selling off in a market, often people sell their gold because they need quick access to cash. But longer term, the benefits come through, and you do see that move higher. I know from my sort of looking at some of this, we've had a very long-term, what they call a cup and handle pattern, where you've seen the gold price sort of move up and have that long multi-year pullback, and it looks like that pattern is still valid. So I would imagine that coming out of wherever we end up here, when we do actually see that Fed pivot, or we see them needing to move, for whatever reason, needing to move back to providing more liquidity to the market, that a lot of that liquidity will probably go into gold. So I think my answer to that question would be that the sharp rise may not come while, sort of aligned with what you said, might not come while there's that uncertainty and fear in the market. But when we get a little bit more certainty about what the future looks like, it probably would be set to rocket off from then. But I can't really imagine a scenario where it's heavily heading down either, while there's that level of uncertainty, because people do like the protection and security that gold provides. So
yeah, I agree. I think the downside for gold at the moment is very low relative to other assets. Even if that upside isn't there in the short term, you're not going to get a negative 7-8% move like you would in a tech stock like we saw last night in gold. So
that's right.
The advantage of it right now.
And I think when we talk about things like asymmetric risk and saying having a position in gold protects you for something that's unanticipated, and when we've got the saber rattling from Russia going on at the moment around dirty bombs and nuclear risks and all of that sort of stuff, you don't necessarily need to put any weight on those things, but gold will automatically protect you or will be positioned correctly to take advantage of anything completely unexpected that happens, because in those situations you do see a rush to gold just for the safety trade. So I think if, like you've highlighted there, if you've got limited downside and quite a bit of upside potential ahead, there's you'd rather probably be a little bit early than late to that trade.
Fully agree on all that. Yep.
That's great. All right. Well, thank you for your time on that and taking us through some of those specifics with those companies today, Branko. Really appreciate it. And we'll get you back next week and see where we are then.
See you next time. Bye.
Thanks.
Thanks so much for being on the show again, Branko. And Chris, I'll see you on the next one. And for the audience, head over to the Discord channel. That's discord.gg/gold. The perfect way to continue the conversation. Chris and Branko will be there for the next 1 or 2 hours after the upload of this video. So head over there, ask your questions, get a response, and tell us your feedback. We really want to hear from you. I always want you to subscribe to the YouTube channel, youtube.com/Ainsley Bullion, for the wide range of informational videos 5 days a week, including specials and more. And while you're there, head over to goldsilverstandard.com. That's bringing gold and silver into the digital world. As we say here at the end, balance your wealth in an unbalanced world. Take care, and we'll see you next time.